Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg, president and founder of Greenberg Financial Group. How are you today?
Great. Good to see you again, Sarah.
Good. You're great to see you. Looking wonderful as always. Got that glow about you? Like you're ready to talk money?
That Tucson, Arizona? You know what
it's a
like?
Green glow. I don't know. I'm going to dive right in because I feel like we always run out of time for conversation. But the world is in a crazy state. We all know for the past couple of years that it just seems to be getting crazier and crazier. And I really want to talk to those people who are getting ready, next phases of life, ready for that retirement phase of life. How do we mitigate risk in this next phase of life?
Well, it's interesting because last time we spoke was probably first quarter of this year. And we had a horrible second quarter. We got killed. And went all the way down into June, and everyone thought the world was coming to an end. And we rallied big. And then we fell off again into September and even went lower. And everyone says, well, how do you get through this? Well, you know, being in this business for, almost 40 years, I've always told people it's about mitigating risk. And how do you even know about mitigating risk or understanding mitigating risk? Well, it's simple. You have to understand economics. You have to understand where we're at. You have to understand why we're here, where we're at, and decide. And the answer isn't you sell everything. So many people, just sell everything and go to cash. Everyone that's ever done that, they're still sitting in cash and never made any money from 2001 or 2008. The answer isn't just going ahead and putting the money under the mattress. The answer isn't, I'm just going to put everything in the bank and, for 10 years you got nothing. You got less than half of 1%. So I understand the fear where we're at right now. But most people never plan. They don't know who they are with risk tolerance. They don't know any of those things. But you have to understand where we are, how we get here, and what's going on.
We've talked about this before, though, Dean, and unfortunately, I don't feel like this is part of our, formal education. And as we're getting through that accumulation phase of life, right, we're making our daily business. We're just trying to make money and save money. And we get to a point where we don't know where we're supposed to head, and we need to stave off some of this risk if we're not going to continue to make that money going forward.
It's funny you say that, and I had friends the same way. Last year, everyone thought they were genius. No different than 1990s, no different than 2003 to 2007, and no different from 2020 to 2022, okay? They all thought they just buy anything and the markets go up. The reason you use advisors, experienced advisors, is because of these type of times. You don't need us when the markets go up because you think you know it all. But it's just like going to a doctor. You don't go to a doctor because you think you know it all. You go to a doctor for his advice. You come to advisors for their advice. Well, we're a little different than just a normal advisor. Everyone tells you 60-40, 50-50, 70-30. You can't just sit there because what's happened lately is we have a change in what's going on with the Federal Reserve, central banks. And the reason we're here today is because we made so many bad decisions from our administrations from around the world. We have pumped so much money into the system because, quote, the pandemic, but it's really for years, even before that, from all the politicians, all the governments trying to stimulate the economies. For what? For them to stay in power. Well, we're paying for that right now, especially the trillions of dollars we paid into the system over the last few years.
You mean they don't just print the money and send it out?
Well, my Jewish grandmother always said that. They don't print the money on trees out there. You can't just have money. But that was the last generation that remembered the Depression.
Yes.
Right? Well, our kids...
Well, we never think we're going to get back there again. Right. Nobody thinks we'll ever get back there again.
Of course not. We were so close in 2008. People don't realize that because the government took care of it. No, Obama didn't take care of it. Nobody. Ben Bernanke took care of it. He understood what happened, and he was able to take care of what businesses went out, what businesses stayed. We're in a very bad situation right now. That doesn't mean to panic. The United States is in a great position compared to other people. Our problem is worrying about everybody else right now and not taking care of ourselves. Our debt situation is in very bad shape. But the markets are going to be okay. But you have to understand that they're not going to do what they did before because we don't have the stimulus. When the Federal Reserve after 2008 and the central banks around the world were lowering interest rates to 0 and negative, you always had a backstop that every time the markets fell, the markets raised. In the pandemic, when the markets fell, what we do? We stimulated the world with money, trillions and trillions of dollars. Well, now what's happened is we have inflation because of that. The problem is they think it's the demand side. It's not. It's the supply side. And nobody on the fiscal side wants to handle that right now. Nobody wants, from our administration side, wants to open up the supply side.
We all thought it was bad when everyone was clamoring for toilet paper at Costco, and that was nothing compared to what it is now, because every part for every car is made in another country. We don't really realize how we are so reliant upon the world as a whole. It's all coming down to this moment in time.
What we realized in the pandemic are healthcare essentials. Things that we need are made in China. Our biggest foe in the world that wants to see the United States crumble as an economy so China can take over. And we allow that to happen. We need to be able to get our essentials. I don't care where my clothes are made. I don't care where my shoes are made. I don't care where my cars are made. I do care where my military stuff is made. I do care where my healthcare stuff is made. I still care where my essentials for us living is made. Why not bring it back to North America? Make it in America, make it in Mexico. Why don't we build up Mexico? Okay? Why don't we do something that's smart? But in the meantime, while this is happening, how are we going to make money at this? We got to mitigate risk. So the portfolios go up and down. There is money that keeps churning around. Everyone that's sold still has money that's going to buy. At some time when the markets get oversold, they're going to go higher.
Dean, I know we're always going to run out of time, and that's why I'm going to stop you on this one. For the people that are sitting on the sofa and are going to stay with us, because we're going to take a quick commercial break in a minute, for those people that are sitting on the sofa and they're saying, yes, these are all problems and we don't know what to do, they can give you a call and you're going to look at their portfolio, which is going to be different than mine or yours,
of course,
and come up with a unique plan.
The first thing we're going to do is figure out what your risk tolerance is. The second thing we're going to do is look at your portfolio and decide, is that portfolio too risky for you or not? The third thing we're going to do is tell you how to mitigate your risk. When we come back from this commercial, we're going to tell you how we are mitigating risk. What we did as money managers, real pulling the plug, real time, what we did over the last few months to mitigate risk.
And I'm going to tell you, if you're sitting on the sofa listening to us, you probably don't know what level of risk you're taking right now. You might think you know, but that's the crazy thing. So you probably want to get a second opinion on that. And Dean is the best one to give it to you. That number is 844-544-4909. We'll take a quick commercial break. We'll come back and talk about mitigating risk in retirement.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. And we were talking before the commercial about mitigating risk. And I would love to know from you, what percentage of your clients or people who come to you do you think actually know what level of risk they're taking?
Very few. Very few understand what the risk tolerance is. And what risk tolerance is really emotional risk. How much you can handle when the markets go down. And how much, everyone can take risk when the markets go up. Very few can handle when it's go down. But what does that really contain? What do you need that money for? Okay? Do you need to live off that money? How soon do you need to live off that money? So all those things are kind of taken into place. And your emotions, greed, and all come into place. There's no doubt. But I want to talk about actually what we have done. Very few people talk about what they do because they don't do it. We actually manage the money. We do the financial plan. We find out what your risk tolerance is. We've built our own models. We've done from the ground up. So we know exactly what we're doing.
Now, I have to say that does make you guys very unique because a lot of other advisors, they outsource a lot of that, and you guys do all of this. So it's very comprehensive.
You've known me for 6 months. You know I'm unique, okay?
I knew you for 6 minutes. I knew you were unique.
That's not uncommon.
It only took 6 minutes to figure that one out.
But, so, what we've done is we recognized the markets that we were concerned about interest rates. No doubt. We knew interest rates had to go up at some time. So we got out of long-term bonds, we went to short-term bond funds. Then we figured that short-term bonds were going to go higher, so we got out of short-term bonds and we went into actual short-term bonds, corporate bonds and treasuries, yielding 3.5% to 4.25%. So we know over 2 years, we're getting all our money back with no problem. Okay? There's number one. Number two, we knew that 40% of your portfolio that everyone says fixed income, that's going to protect. No, that's why we did it. Because if you're just in the regular bond fund, that's down 26, 28%, not protecting you. We protected there. Number two, we raised cash. So out of the other 60% that we have there, we raised a good cash. Anywhere from 15 to 25% we put in cash. Number two, we hedged for our accounts. We bought some S&P 500 puts on it, so which means if the markets go down, those go up in value. Number three, we bought some of the inverse fund the last time we rallied to up to a point that we thought we'd resist it. So as the market came down here, those went up in value. So does that mean we didn't lose? Of course we lost, but we mitigated risk to cut it more than half. That was what was important to us. Now as the markets go down, we start reducing that risk, that mitigating the risk. We come off that, we take the profits, we look for the markets to rally again and do the same thing. This is the way the market's going to be for the next 2, 3, 4, 5 years. Reason being is the Federal Reserve is not going to be able to lower interest rates for a while because of inflation. Inflation is not going away. It's a cycle. It's going to take a while.
But let's talk about inflation because inflation has just gone and skyrocketed and it's on our everyday staples. What are you talking about?
The president just said it's only up 0.1%. It's nothing.
Oh, yeah.
Yeah, that's what he said. It just went up just a little bit.
I must have missed that. I'm so sorry. But I mean, staples, things that we really need, obviously, like milk, bread. I mean, we can go on and on and on. But these things, how do we...
The grocery store. I cannot believe how much it costs in the grocery store right now. And I don't go shopping, but I see the bills. It's unbelievable.
It really is. And these are things people rely on. So they're having to make decisions. Okay, should I buy a loaf of bread? Should I put gas in my car? I mean, these are decisions we never thought we would have to make.
Exactly. And it's going to be harder and harder because energy prices, yes, gasoline prices have come down temporarily. But they're going to go back up.
They came down, but they're not
down.
They're not
exactly.
Down.
It's all political. We know that at this time, which, and they go back up. It's going to be a while. So you got to look at your portfolios and mitigate risk. The other thing you can do too is, and it's all about some of these guaranteed fixed annuities, where you can go get the 3.5%, 4%. There's things you can do now that 5, 10, 20 years ago we couldn't get. We couldn't get because they didn't offer those type of interest rates. There's things that you need to do now. You've got to stop burying your head in the sand, realize things are different, and figure out what you're going to do forward. And since you cannot do that, because most people, you know what they're doing now? They're not even looking at the statements.
Well, and to your point, their statements are not a plan, right? A lot of people think here's my statements. That's not a plan.
No. A plan is coming in and speaking to Stephanie, Dylan, Todd, me, somebody, and going through it. Find out what your emotional state is on this. And it should not be any different than what it had been before, even though it is. Selling out at this time is not the right thing to do. Going and taking your assets that you want for growth and putting it into a fixed index annuity now because you're okay getting 4%, but you're never going to make back to 20 or 30%. Do you realize the markets go up 90% of the time? Do you realize that when you have times like this, then the markets then average back 10% all the time? And I always said this, when we had that time frame between 2000 and 2010, and we fell 50% twice, okay, I said we're owed really good returns. And we started going up 15%, 12%, 25%, 18% in order to average the 10. And guess what happened? All of a sudden we averaged 10% over the next time. Now we ran up too much.
But who you felt terrible for in 2008 were those people that were set to retire that year and didn't have the luxury of time.
Because they didn't plan.
Well, but you know what? Don't you think it's also a generational thing where people say, well, my father or my grandfather didn't have a financial planner? But you made an excellent point. There was not those tools in the toolbox back then. Everybody had a pension, everybody had Social Security maybe, and that was it. We have tools now that can mitigate a lot of this.
The truth is, financial planning was more like estate planning. Financial planning was not real simple. Most financial advisors couldn't make it simple. I didn't do a lot of financial planning up to about 5 years ago because it wasn't simplified. It was all these, where financial planning came from was from insurance salesmen to basically sell you insurance, which really is estate planning. Today, you got real financial planning programs that would take into consideration your insurances, your estate planning, your Social Security, your Medicare, all the things that you need to plan for. You shorten if you have a gap shortage in paying federal, it takes in for federal employees versus other employees. They're great. The program we use is great. It's a whole thing. Then you finally get to your investments and how much you get it. It's so different than what it was.
So when they pick up the phone and call, they're going to ultimately meet with either you or Stephanie or Dylan, and you look at their statements and help them to analyze if they're on the right path.
This is the way it works with us. Todd, Stephanie, and Dylan, okay? They're the people that I brought in basically a succession plan. I've got another 12, 15 years. I want to teach them, mentor them. They've got 7 to 15 years in the business right now. So another 10 years, they're going to have it. They're the planners. Dylan's also learning the investments. Todd's learning investments. Stephanie knows the planning and all these things inside and out and all the retirement. We work as one team at Greenberg Financial Group. Maybe it's the 20 years of coaching I did. I don't like it when we're individuals. We're a team.
Better as
and
together.
A team works together. It's great for the clients, it's great for the company, and it's great for me. You have to be a leader to teach. And everyone, Dave, Sue, everyone in our office, we work as a team.
So whether or not you already have a financial planner you're working with, or perhaps you don't and you've never even thought about any of these topics, if you are in sort of that retirement red zone, this is something you need to visit right now. Get that second opinion, and that number is 844-544-4909. We talk too much. We'll come back, and we're going to talk more about mitigating risk in approaching retirement.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group, and we are talking about mitigating risk when it comes to retirement. And something that just dawned on me before the break
It's not just retirement.
What? Mitigating risk in general.
Right.
This has been a very tumultuous time period in all of our lives. I don't think any of us could say that there has been a more tumultuous time.
I would say also the truth is very few advisors understand how to mitigate risk, because most advisors give the money to other people and their job isn't to mitigate risk. Institutions, pension plans, they mitigate risks. I felt my whole life I want to be the best. So I've always understood. I've always learned how to do that. So if I'm going to manage money, that's what I do. Okay? I'm a New Yorker. I could be working on Wall Street. I never wanted to. Quality of life was more important to me than working on Wall Street.
From one New Yorker to another, I understand this attitude. I want to know, though, if I come to you, and I've really never had these types of conversations before, and you ask me, how much do you need? How do I figure out what's that magical number? How much do I need? Because I'm assuming that, approaching retirement, especially, I'm going to need less to live on, but I'm not a simple girl, Dean.
I never want anyone to live on less, because you worked hard your whole life. And there's that sweet spot in your 60s and your 70s, as long as you have you're going to spend more.
The go-go years.
Because, like you said, you're not a simple girl. So your husband better make a lot of money. Because you're going to want to do things while you're healthy that are going to cost more. But just as life takes on, which I've seen and observed, as you get older, you're going to do less. And the trips you go on are going to be less. And even the cruises you might go, instead of going all over and you'll go take a cruise, but because you can go at the last minute, you're going to go on a cheaper cruise. And you're going to go on and you'll get an upgrade because you can go at the last minute. So the things you want to do are going to be dependent on how you feel. And you're also going to be smart about your money. I have never, in all my years, ever had anyone run out of money. Ever run out of money. Because as they've gotten older, they didn't have the energy to do all the things they wanted to do. But I'm a big proponent is do things early when you get it. Don't think you have to save it. I've seen, unfortunately, too many people pass while they think they have to save for later on. But what you need to do is know what your bills are, how much you're going to have to pay, and what your lifestyle you want, what kind of things you want to do. And then we sit and we kind of plan all that stuff.
Because longevity should not be the risk. It should not be one of the risks that you're going to outlive your money.
Right. Right. And one of the things we do is when things are bad, everyone pulls back. It's just normal. But when things are good and people make money and we're sitting down doing a review, I say, take some extra money now. You made an extra 20, 50, 100,000. Go do something with it, okay? You gave it up for a year or two. Go do something. Take your grandchildren, get your family, do the kitchen, buy a car. Do something with the money you just earned. And they don't hear that from other people.
Yep.
We love telling people to do that because you know why? It can go right back down the other way.
Well, you kind of just reminded me of how personal this relationship is between an advisor and his clients. I mean, this is not a cookie cutter plan that everybody gets. It's something so individual. I mean, I have 4 kids. I know what my future might look like in my best, world, but somebody else's vision is going to be different. And so you're just helping people sort of realize that vision.
We're not only that, advisors, sometimes I'm a psychologist. I'm helping people get through their relationships with their children and grandchildren. I try to help them understand just putting money away and them not knowing about their money is not good either. I want them to educate them with investments. We don't do that enough. Open accounts for your grandchildren now or your children, so when they get it, they understand it's put away. We've opened up Roth IRAs for their children and grandchildren and put that money away for them so they know it's staying away until they're much older. Buy insurance policies for when the kids are 1 year old so that they have something. And what I did when they were one, I bought it, and when they get married, now it's yours. And otherwise, I stay the beneficiary. You know what I'm saying? You start paying for it. And it's just things that you do so they start understanding the world of finance. Because nobody knows better than yourself, as you can teach your kids, but nobody teaches it because they don't teach it in the schools.
So the best way for someone to prepare for a meeting with you is to do what?
Call us. Come see us. Be open. Be friendly. We'll be friendly with you. And tell us what's going on. Tell us what your concerns are, who you are, what your family is, what you want to do with your money, and tell us how you want to spend your retirement years.
Well, and a lot of people might not know those answers, so I challenge you to get out a pen and paper right now and write down some of these things you're thinking about, questions you have based on conversations. This is a great thing to come prepared with. What is my question? Sometimes I don't even know the right questions to ask.
Everybody thinks it's just numbers. It's so much more than numbers. It's talking, building relationships. It's trust. When I get into relationships with people, I'm expecting them to be with us 10, 15, 20, 25 years. You know what I mean? Because we go through all that with them.
Well, and I love that there's a team behind you, because it really is not just about one person, right? It's about a village. It takes a village. And so nice to know that it's all happening under one roof. So if you have an advisor or you don't, and you want to get that second opinion, you're approaching sort of the retirement phase of life, or you just want someone to help you know where to go in this very uncertain world, this is the time to do it. You don't know what tomorrow's going to bring. So that phone number again is 844-544-4909. The world is a risky place, but we can take that fear factor out of the equation if we have proper planning.
We get proper planning, mitigate risk, save on taxes, all that stuff. It all comes into play. And still be able to participate when we can make money.
And enjoy those go-go years. I love what you said, that you encourage your clients to enjoy this time of life, because I certainly don't want to work this hard my whole life and not be able to enjoy it.
Absolutely.
Thank you so much again. We always run out of time. We hope you'll join us on the next show and enjoy your retirement.